I want to start with that impairment charge. Is this the worst case scenario?
Good morning. So we've taken the 937 million impairment charge. 2/3 of that does reflect expected losses. Only a third actually reflects actual decline or deterioration in our lending book. It is difficult to be prescriptive and definitive, but we are saying today that should represent between 70 and 85% of our full-year outlook. I think the underlying message that our capital remains strong, and in many other aspects of our performance that we're reporting on today, we've made good progress in terms of cost and transformation. But obviously, the impairment number, which is a real reflection of how COVID-19 is impacting our economy and all businesses, and that includes banks, is obviously very apparent.
So how has the easing of the lockdown been impacting your economy, or how has the recovery been since the easing started?
Yeah, I mean, sitting here today, I actually feel cautiously more optimistic than I did when we gave our first quarter trading update back in May. The Irish economy has opened up sooner than originally planned, and there's some positive early trends. We're not out of the woods yet, and there are still obviously clear challenges, but high-frequency data suggests house prices are far more resilient than expected, and claimants on unemployment sort of support are 52% below peak. We've had a new majority government being formed, and they have launched a material fiscal stimulus package, which is being well received. That represents 11% of Ireland's GNI, and on a per capita basis, really ranks up there amongst European country peers. And the third thing that we're seeing is just observed behaviour and trading from our business and personal customers. So after effectively, the trough of April, May, we're seeing mortgage applications actually higher in July, 25% up versus July 2019. Let's see how those translate into actual written business in the second half of this year. And debit and credit card spend is back to pre-COVID-19 levels, although I would be cautious that some of that is pent-up demand. So still some real challenges, but I would say I'm marginally more optimistic than I would have been back in May.
Francesca, you, along with a number of other CEOs of Irish banks, have been called in over the past month to speak to the finance ministry. The government owns about 14% of your bank. Are you worried at all about excessive political interference in your bank and other Irish banks?
So the government is a major stakeholder with shareholder with 14%. We are the largest entity of the Irish economy, so you'd expect the government to be very interested in how we lend to Irish businesses and households. There is no political intervention in terms of how we price, how we charge customers, and how we grow and manage our balance sheet. But obviously there's a lot of interest, and a lot of that relates to payment breaks. And we've been, as an industry, really front-footed in Ireland in providing payment breaks and emergency liquidity to households and businesses when they needed it most. So across all of our business, Ireland and the UK, we've agreed 105,000 payment breaks, and those have been very well received by customers, and I think have given them the breathing space they needed during the real trough of the pandemic.
What kind of demand are you seeing right now? I mean, I assume that you initially saw a flurry of demand as people started to realize they weren't going to be bringing in any revenue. Has it stayed that high since the easing started?
It hasn't. So we agreed 105,000 payment breaks across our markets for the first 3 months, and those have now begun to expire. And what we're seeing is that about half of our mortgage customers in Ireland are opting for an extension. Slightly more businesses are opting for an extension of another 3 months, and that's partly because the government stimulus package that I mentioned hasn't actually landed yet. It'll be landing in the next few weeks. In our UK business, we've seen actually the take-up being lower because government stimulus packages have landed, and they're being effective, and businesses are saying, actually, I'm okay with these first 3 months. I can go back and resume my original capital and interest payments, which is a good sign of economic recovery. But obviously, some customers, some businesses are going to really struggle with social distancing and the new normal, and we have taken an impairment charge. Part of that really large number that we talked about, 180 million of that, is because we don't think all payment breaks will resume back to the way they were before COVID-19.
You've been targeting return on tangible equity of 10% in 2001. In February, you had to cut that. Where do you see it now?
To be honest, I think it feels premature to start being explicit about our medium-term targets. The world has changed in the last 6 months, so we're not giving guidance beyond 2020. Obviously, in the more medium term, getting to a return on tangible equity of 8 to 10% plus is still the longer-term objective. Right now, our focus is on supporting our customers get through this crisis, and we have given guidance on costs coming down, and it's improved better than we said in 2021, but we're not being explicit about more medium-term objectives today.